Today, we will be discussing 3 dividend stocks that present great investment opportunities. These stocks offer not just attractive dividend yields but also hold the potential for considerable growth, making them highly appealing choices for investors. Let's explore these stocks in depth and evaluate their investment potential for long-term returns. First on our list is Cal Maine Foods, symbol CALM, which is a leading producer and marketer of shell eggs in the United States. The current share price of CALM is around $47. So far this year, the company has paid $4.40 dividend and we still have 1 quarter left. This translates into a yield of more than 9% for the 3 quarters. However, for next year, we expect a dividend in the range of $2 to $3. This means CALM is currently offering a forward dividend yield of 4 to 5%. But dividend is not the only attraction for CALM. We see good potential for capital gains from current price as well. The company is expected to post earnings per share of $4.4 to $4.60 for coming year, 2024. This translates into an attractive price to earnings multiple of 10.7x. Also, the company is trading at attractive price to book ratio of 1.6x, which is much lower than consumer staples sector median of 2.6x. Based on the price chart, we see CALM hitting price of $65 in the next 12 months, thus giving potential return of 35% on the top of a dividend yield of 4 to 5%. The stock is presently trading closer to 52-week low. It is always better to buy good companies at cheaper prices. Hence, investors can use the strategy of split buying at current levels with dividing your money into 5 equal lots and do the first buying at current price. We recommend 45, 42.5, 40 and 38 as the next 4 buying levels. In this way, the average buying price will come out to be around 42.5. Investors can also opt for selling put options for strike 42.5 with expiry 6 or more months to lock in premiums. Cal Maine is the largest egg producer in the United States and has benefited greatly from increased egg prices. We may not see a sharp increase in egg prices as much as we saw in the past year, however, there is no reason to be bearish on egg prices as well. Food inflation will be here to stay, and long-term trend in food prices is always inflationary. Hence, CALM is looking very attractive at current levels. Our second stock on the list is Pfizer, a reputable pharmaceutical company which is an appealing investment choice at current price of around $37 a share. We expect the company to pay dividend of $1.60 per share in the coming year. This translates into a yield of 4.3%, and not only this, Pfizer has strong growth prospects too. Although the COVID vaccine sales will decline in the coming quarters, but Pfizer is going ahead with acquisition of Seattle-based cancer drug developer Seagen. Now this is an interesting development as Pfizer believes that Seagen could contribute more than $10 billion to its 2030 risk-adjusted revenues, as the company plots its way to grow from a forecast $52 billion of non-COVID revenues in FY25 to nearly $85 billion in revenues by 2030. Some investors believe the deal worth $43 billion is too expensive. However, management is optimistic that Seagen will bring additional lines of cancer drugs into their business which can be worth the money they are paying. With a forward EPS of 3.35, Pfizer is trading at an attractive price to earnings multiple of 11x and price to book ratio of 2.1x. These valuations look quite cheap considering Pfizer is a big company with market cap of more than $212 billion. We have a target price of $55, which implies an upside of 48% in addition to a solid dividend yield of 4.3%. Here again, we will recommend split buying strategy for Pfizer with first buy at current levels and then further adding on each dip. Selling put options with longer expiry is also a good strategy. Our third stock on the list is a REIT named EPR Properties, symbol EPR. Currently, EPR is trading around $41 and offering annual dividend of $3.30. This translates into a very attractive dividend yield of 8%. Most of their properties consist of experiential real estate like movie theaters, eat and play, amusement parks, etc. An important concern for investors is 2 of EPR's major theater tenants are close to bankruptcy. This puts a lot of uncertainty on what's going to happen next, and it is the main reason why the stock price is trading at depressed valuations. The market is presently valuing the stock after writing off entire movie theater portfolio. However, EPR has a strong and profitable portfolio and we cannot write off movie theaters altogether. The company is also growing its experiential businesses. Recently, EPR Properties bought a climbing gym for $43.3 million in Williamsburg. Our due diligence on EPR suggests the dividend will be safe even without any income from theater business. At the same time, company is expanding into other avenues. While we do not see any potential for major capital gains right now, the stock price can still go to $45, which implies a 10% upside from present levels. EPR also offers a good opportunity to sell put options. Investors can sell put options for strike 40 or 38, with expiry 6 months, to bring their buying price lower. As we say, the lower you buy, the better it is. Moreover, owing to limited upside potential, EPR is also a good candidate to sell long-duration covered calls for strike 45. There are many other stocks which offer good dividend yield and growth opportunities at the same time. Stay tuned to our channel to get info about potential opportunities totally free. Thanks for watching.